Did you know that a single data release can send the stock market soaring or crashing? If you've ever wondered how professional traders predict market movements, you're in the right place. Today, we're breaking down the economic calendar, what it means, how to read it, and how you can use it to stay ahead of the game. Why the economic calendar is crucial. Investors, traders, and policymakers rely on economic data to make informed decisions. Economic indicators drive stock, bond, crypto, Forex, and commodities markets. This video will cover major and minor indicators, their market impacts, and how they're used together for predictions. How to understand the economic calendar. What is an economic calendar? A schedule of important economic data releases that impact financial markets. Key components: date and time, when the data is released. Event name, type of economic indicator. Survey, consensus estimate, expected value based on analysts' predictions. Actual, the real data when released. Prior and revised, the last reported value and any adjustments. Major economic indicators and their market impact. 1. Non-farm payrolls, NFP, measures job growth in the U.S., excluding agriculture. Higher than expected. Strong economy, bullish for stocks, bearish for bonds. Lower than expected. Weak economy, bearish for stocks, bullish for bonds. Consumer Price Index, CPI. Inflation gauge measures inflation through changes in consumer prices. Higher CPI, inflation fears, hawkish Fed, higher interest rates. Lower CPI, lower inflation, potential rate cuts, bullish for stocks. Retail sales, shows consumer spending strength. Higher than expected, strong consumer demand, bullish for economy. Lower than expected, slower economy, potential recession signal. Gross domestic product, GDP, measures overall economic growth. High GDP growth, strong economy, but could lead to Fed tightening. Low GDP growth, possible recession, Fed may cut rates. Federal Reserve decisions, FOMC rate decision. Interest rate hikes/cuts directly impact borrowing, lending, and market sentiment. Hawkish Fed, higher rates. Stocks drop, bonds rise, USD strengthens. Dovish Fed, lower rates. Stocks rise, bonds drop, USD weakens. ISM manufacturing and services, PMI business activity and economic health indicators. Above 50, expansion, bullish for stocks. Below 50, contraction, recession warning. Unemployment rate, reflects job market health. High unemployment, economic weakness, potential Fed intervention. Low unemployment, strong economy, but risk of inflation. Some of the minor economic indicators: personal spending and income, consumer financial health, durable goods orders, business investment confidence, housing data, market strength, new home sales, housing starts, etc. JOLTS jobs openings, future employment trends, challenger job cuts, layoff trends, and labor market risks. How traders and investors use these indicators together. Predicting a recession. Rising unemployment and falling GDP with weak retail sales, this is a recession alert. Investors shift money to bonds, gold, and defensive stocks. Predicting an interest rate hike. High CPI, inflation, and strong retail sales along with low unemployment means the Fed is likely to raise rates. Expect higher bond yields, lower growth stock prices. Predicting stock market booms. Strong NFP job growth added with low unemployment and rising consumer spending, this gives us bull market potential. Investors buy tech, growth, and cyclical stocks. Now that you understand the economic calendar, you have a huge advantage over the average investor. The next time you see an economic release, you'll know exactly what it means and how it might impact the market. Call to action. Subscribe for weekly market updates. Comment below, which economic indicator do you find most useful? Which would you like for me to go more in depth about? Comment below. Follow me for real-time trading insights.